Hey everyone, welcome to Chart This with Dave Keller. It's Monday, December 16th. Happy Monday. Hope you all had a joyous, long, it wasn't a long weekend. It was a regular weekend, but it felt like a long one. We packed a lot of good stuff into the weekend here in Redmond, Washington. By the way, overcast day here, which is pretty normal between November and April, but I hope the sun is shining, whether outside or inside, wherever you're at. Thanks for joining me here on the market recap. It's Fed week, right? And I think when you look at the week to come here, it's all about sort of waiting and seeing in terms of what we learned from the Fed meeting on Tuesday and Wednesday. Highly unlikely we will hear anything other than a 25 basis point cut. I think the main thing to focus on is the commentary section, right? The Q&A, because that's where I'm sure reporters in the room will try to tease out any clarity they can about the fabled dot plot, sort of the expectations about future interest rate policy by the different Fed governors, trying to anticipate what that might look like in the beginning of 2025. I feel like in the second half of 2024, we've sort of followed a pretty, I guess, easy to understand script about sort of regular pace of cuts. Sort of had to continue to cut at each meeting. And that changed a little bit, but overall we sort of settled into a normal expectation. I think next year is kind of the Wild West of expectations. I'm seeing a lot of differing expectations about how many rate cuts we might see, how long they will be cutting rates, what that terminal rate might be, or what that final rate might look like. So a lot of questions that I know will be asked, and anticipate and expect significant market reaction based on what sort of things that we learn. For today, nice sort of mixed day for the markets. We're sort of continuing the growth over value theme, which has been the story for really for much of the last couple months here. Really, the second half of the year has been about, and really sort of the fourth quarter on, sort of post elections, have been all about growth over everything else. We're continuing to see Tesla, Broadcom kind of names, Alphabet just blowing out to new highs, but the average stock is not looking particularly good on a day like today, where some of those names made new all-time highs yet again. About half of stocks in most indexes were down, right? In the S&P, over half of the members were down today. So it's very much one of those weird markets where I would argue that your portfolio probably does not feel as good as the markets unless your portfolio is like the top 10 growth stocks in the S&P and you don't have anything else. You're probably feeling pretty good about things. Otherwise, you're probably finding some areas where, where your portfolio is starting to come off a bit. And I think that's going to be the real question going into the beginning of next year, is that leadership rotation. I do see some questions coming in. Apologies. I did start about 15 minutes late today. I'll try to not make that a habit, but I had to shuffle some things around to get back in time. But I appreciate you tuning in. We're live streaming on Facebook, on LinkedIn, on YouTube, and on X. I can see questions that you put in on any of those platforms. So as we're going, if a question pops in your head, please pop it in there, and I'll do my best to grab a question or two at the end of the stream. Anything we don't get to, we'll put it in the mailbag. We had a fantastic all mailbag edition on Friday. If you missed that, please watch it on our YouTube channel. Some really thoughtful questions from all of you over the last week or so, and I really enjoyed sort of answering some of those questions on your mind. All right, getting to the market recap here. S&P sort of slightly higher, Nasdaq big time higher, Dow down, and that has been, I feel like, what the market has sort of been like since November 8th this year. Sort of the mega cap growth great, everything else okay, and some things not okay. The Dow was actually down 0.25% today. The S&P closed just above 60.74, and that's up about 0.33% from Friday's close. The big winners, the Nasdaq Composite, up about 1.25%. Mid caps were slightly lower, small caps slightly higher, so sort of mixed results across different what we call cap tiers. Look at the VIX moving higher today. So while the S&P and the Nasdaq were up, the volatility actually increased today almost by a full VIX point. So we finished today around 14.7. 15 is sort of that basic cutoff for me. I always have an alert set on the stock charts platform for VIX over 15. While that does not guarantee that we're in like an end of the world, doomsday scenario, I've rarely seen the market have any real trouble while the VIX is below 15. Once the VIX gets above 15, at least that opens the door to possibilities that we could be in for a period of instability. And then I have to pay more attention to some of the charts that we'll reflect on through the course of the show today. So VIX very close to that sort of initial warning sign for me, telling me we may be in no longer a low volatility environment. For today, we're remaining so. Interest rates overall, I mean, honestly, pretty flat from where we were on Friday. The 10-year point's right around 4.4%. The long bond is just above 4.6%. The 5-year point is right around 4.25%. The dollar index, no real change from Friday. So, honestly, going into this week, which is, Fed week, Fed meeting tomorrow and Wednesday, Fed press conference tomorrow afternoon, 2 p.m. is when we get the latest, any change to the target rate. 2:30 p.m. is when we have the press conference with Chair Powell. Usually you have kind of a lighter volume, wait and see kind of treading water environment until Wednesday afternoon. There's no real, there are some earnings, but not, move the market kind of earnings like Alphabet or Tesla kind of reports. It's more random retail things, some technology, Accenture kind of names, which are fine. We should pay attention to them, but the real story is going to be the Fed. So not surprised that rates are kind of holding steady here as we, all eyes and ears waiting for that Fed announcement on Wednesday. Gold and silver slightly higher today, but not much of a change, to be honest with you. The GLD was up about 0.25%. Energy areas of the commodity space were down and pretty good in some cases. The energy sector was your worst performer, as we'll get to in a short while. We've talked about the bull case for cryptocurrencies. We've talked about the bull case for Bitcoin, and it's continuing to work. Over the weekend, Bitcoin had a pretty decent run. At one point earlier today, almost got to 108,000 for the first time. It's currently trading just above 106, but 100 was sort of left in the rearview mirror sort of Sunday into Monday, and now we're, for now, holding above that level. When you have a big key round number, big breakout level, for me, it's all about getting above that level and then holding it. That's why we talk about Meta and, resistance, Alphabet resistance, Apple resistance, right? It's breaking above that resistance and then holding that breakout level, which we would call a pivot point. I would say with Bitcoin, 100,000 is that pivot point. And for now, I'm happy just, making sure that it remains above 100,000 and overall thinking that that we're in good shape from there. Looking back at what we just talked about, I don't own the S&P, but I own S&P 500 funds for sure. I do own the GLD. I do own Bitcoin and Ethereum. I think that's it from what we looked at so far. All right. Looking at the sectors, the 11 S&P sectors, 4 up, 7 down today. The consumer discretionary sector, number 1, the XLY, that is, was up about 1.33%. Technology, the XLK, up 1%. Comm services up 0.4%. Industrials were flat and everything else was down. So once again, we have the FANG sectors up and everything else down sort of environment, which again has been the story of these markets in the last 6 or 7 weeks, sort of post-election. It's all been strength in the FANG sectors and less impressive charts elsewhere. Energy down the most, down 2.2%. As we get to the market carpet, the heat map visualization, you'll see that there's a lot of red in the energy space today. Healthcare, number 2, down 1.2%. That's another area of weakness here recently. Materials, number 3, down 0.9%. As a reminder, on Friday, which is when we formally update our market trend model, Friday after the close, the mid-cap and small-cap models did turn bearish on the short term. The main model for me is the S&P 500 model. That's what I've been running this on for years and years. I do run it on a bunch of other things just to track and for some other purposes, and mid caps and small caps did turn bearish in the short term. Now, it's not a real danger sign just yet. The short term model can and often does turn negative, even if the sort of overall trend is still fine. The medium term trend model turning negative is when I start to be concerned about potential, more of a pullback scenario and more of an area where we might want to think more defensively. So for now, this is just short-term pullback within a long-term uptrend as the general assessment of the model there. Looking at the Mag 7 and friends, Tesla continuing to, just have a nice uptrend. The chart of Tesla reminds me of the conversation I had with T.G. Watkins. That was the latest episode, actually next to last episode of our Market Misbehavior podcast. I had 2 really good conversations last week. T.G. Watkins, who's the director of stocks at Simpler Trading, and we talked about Tesla, which I'll come back to in a minute. And then Frank Capillari, who runs his own firm called Cap Thesis, but he was at Instinet, actually started in the industry with Alan Shaw and Louise Yamada at Smith Barney. So two really good conversations. Those are both posted on my YouTube channel and hopefully very soon on your favorite podcast platform, but working on getting all that set up. The new year will be the time when all of those things are hopefully clicking along with no issues. Looking back here at the Magnificent Seven, I mentioned my conversation with T.G. Watkins because we talked particularly about Tesla. He talked about using a leveraged Tesla ETF, the TSLL. We talked a little bit about that, but it was more just identifying breakouts and then riding breakouts as long as possible. And that's what strikes me with the chart of Tesla, right? I mean, would you predict that it would be up 6% today? I think predicting 1 day's percent movements can be incredibly difficult, if not absolutely impossible, and probably not a great use of your time. But recognizing that a chart is in an uptrend and assuming that uptrend is going to continue until proven otherwise, what I call innocent until proven guilty, that makes a ton of sense for me because you're basically assuming that a trend is in place. You have tools and techniques to follow those trends higher and recognize when those trends are shifting or, have a warning sign, a trailing stop of some sort. That's how I would approach a chart like Tesla. So I'm thrilled that it's going up because that's kind of what the chart has been saying. It's continuing to work. I would say a lot of these charts have a similar sort of framework right now. Alphabet up about 3.6%, Amazon up 2.4%. Only one of these leading growth names was down. It was Nvidia. And one of these screens that I'm going to show you, I might have gotten rid of them all, but when I logged in this morning, big banner at the top of my login, my phone's lighting up with the text from Stock Chart saying Nvidia broke down below support. 132 was the level that we've been talking about. It was broken today. We actually closed right at 132, but on an intraday basis, we did break below. We'll look at that chart here in a little while and talk about some additional things to think about as we test and maybe break down through that lower level of support. As I bring up the market carpet, as a reminder, I can't see all the questions. I do see some that came in, and I actually see some questions that came in before I'd gone live, and sorry for that. Those of you waiting on YouTube patiently, I appreciate if you're still here. Thanks for that. I do see the questions that have come in. Please keep them coming. Anything we don't get to on the show today, I will put in the mailbag and hopefully get to very, very soon. All right. Looking at the heat map, 3 ways that we use what's called the market carpet on stock charts. Number one, sort of your overall, takeaways, looking across the board at 500 charts in one image. Question 2, what about the large names, the big dogs? What are they doing? And then number 3, any sort of opportunistic outlier, kind of different ideas to highlight. So general, observations here. I mean, I would say number 1. It's some of the brighter red that you're seeing in sectors like energy, materials, and healthcare. Those certainly seem to be, 3 of the concentrated areas of weakness today. Besides that, general less than impressive days for industrials, real estate, utilities, consumer staples. Those are some of the defensive sectors, particularly consumer staples. Another observation I would say is even within the sectors that were probably the strongest, like communication services and discretionary, it wasn't homogenous. And what I mean is, like, it's not like everything was working. So for example, in discretionary, you have Starbucks, Borg Warner, Wynn, MGM, LVS. Those are some gambling names. And then others like coffee down pretty good today. In the communication services, the old school telecoms, Comcast media names, Lumen, down pretty good today. So, it wasn't again, this is not the type of environment where kind of everything's working. That's what happens when the market's going up and breadth conditions are very strong. Here we have the market still going up, but the breadth conditions are actually a lot weaker, which means you have days like this, where when you look underneath the hood, it looks like everything's okay. Nasdaq up over 1%. You look underneath the hood and you go, ooh, okay, hold on. A lot of things are actually down pretty good today. Solar names and technology all getting dinged. So I think this is one of those times when the chart of the S&P or the Nasdaq is a little bit misleading in terms of the actual strength of the market, which is not in the average stock. It's in the biggest names. And let's get there. The big dogs and what they did. Of course, Broadcom up over 11% is a pretty noteworthy move. This thing has essentially gone vertical, powering right above $200 and not even blinking, going up another 20% here to get to 250. Alphabet recently breaking 2 new all-time highs above 190, continuing to follow in on those gains. And one of the things we talked about, right, is what would allow this market to show additional strength beyond what we've seen to push the S&P above 6,100, above 6,200, and further going into Q1. I would say it has to include charts like Alphabet continuing to work, charts like Amazon continuing to work, right, powering above resistance, and then just continuing these uptrends. So for now, that's certainly true. Nvidia down is noteworthy as well, starting to diverge a bit from the rest of the Magnificent Seven. For a while, it's been sort of the Mag 7 names, and then Tesla was kind of this other one off to the side. Now I think you've swapped Tesla and Nvidia, which is crazy because not too long ago, Nvidia seemed like the perfect chart, and then everything else was sort of like trying to look anywhere near as good as Nvidia. Boy, life has changed a little bit with Nvidia. Again, still not that bad of a chart, but kind of a short-term head and shoulders top that we'll talk about. And then finally, any sort of outliers. I feel like I've kind of covered this pretty good. And I would I would highlight some of the names that are not working, even though some of the larger names are going up. And that's what concerns me, right? What concerns me would be more and more stocks actually breaking down, because that is, while the S&P and the Nasdaq would not reflect that, that would certainly start to weigh on things at some point, because as investors, we're not going to enjoy having that much red in our portfolio. And then that's when you start to get nervous and you start to make changes. And that's what can often bring a lot of other things down as well. So that's what I would say in terms of the general heat map. And again, this is one of those kind of weird markets where the market is going up, but the breadth is not particularly good. By the way, we are getting near year end here. I'm not entirely certain what my programming schedule is going to be. This is my first time in the chart this era that I have a holiday season to contend with. So I'm doing some thinking in terms of how to program the end of the year. So I'll keep you updated as I figure out what I'll be doing with the last 2 weeks of the year as we go through the Christmas holiday and the New Year. But I did want to let you know I have a free webcast coming up tomorrow on Tuesday, December 17th. I'm going to conduct what has become an annual exercise for me that I absolutely enjoy, and I hope you can join me go through it. It's called Trading Reflections, 10 Questions Mindful Investors Ask at Year End. At the end of every year, I think what a mindful investor should do, and what I will do with all of you watching, is take a step back and reflect on my own performance. Think about, wins and misses, what I did well, what I did poorly, how I would grade my routines, my consistency, what trades did not go well, and what can I learn from it. I'm going to do that all with you as part of it. And I encourage you to attend, number one, just to learn the 10 questions, and I will encourage you to answer them on your own, but just to reflect on your experiences. I think mindless investors, miss the opportunity to learn from their experiences. They're good experiences, but especially they're painful experiences, right? It takes effort, but it is often very well worth it. You can sign up for that event by going to marketmisbehavior.com/reflections. You can scan the QR code that you see on my blue shirt on the image, and I hope you will join me. You can also click on the description if you're watching the replay on our YouTube channel. But please make sure you tune in tomorrow. That's the 17th at 1 p.m. And if you can't make it live, by the way, just make sure you sign up, and I will send the replay out as soon as it's done. All right. Getting to the charts here as we finish off our market recap, so the S&P, while up today, really has not gone anywhere. And I think that's important, right? If you look at, where the S&P finished November, it was right around 60.50. It was actually slightly below that. I think this is the last trading day in November right there, right around the Thanksgiving holiday. December opened, and the first day of December closed around 60.50. We're 25 points above that about 2 weeks later. So 2 weeks into December, we've gone a big nowhere, right? We have tested 6,100, but this is a sideways trend. So what's happening right now is you have charts like Tesla and Alphabet spiking, Broadcom just accelerating. You have stocks like Nvidia, what else would be a good example of this? I'm blanking. There was one that was just pulling back that I was looking at. I don't know if I grabbed it for the show or not. But you have stocks that have been trending higher, but are just starting to pull back, like an Nvidia, right? Not broken, not horrible charts, but not great. And then you have these Nike charts, which are just absolute dogs of brutal, technical configuration, just continuing to underwhelm investors. And so right now, you really have a mixed results. And and when you take all of that in aggregate, the biggest names doing so well is keeping the S&P 500 pretty elevated, even though the breadth conditions are getting pretty rough. We'll look at the bullish percent index in a few moments. It's not good. And it's pretty common. It's pretty consistent with previous market tops. What often happens at the end of a big move, at the end of a big bull trend, is investors get defensive. And maybe what's happening right now is instead of getting to the relative defense of, Costco and Pepsi and, defensive staples kind of names, maybe people are getting defensive going into the Magnificent Seven names and sort of, doubling down on Amazon and Alphabet and trying to weather things. Perhaps that's it. So for now, the S&P is holding up okay. From a technical perspective, I would say nothing really to be concerned about on the S&P. And if this is the only chart I'm looking at, I'm thinking things are pretty good. I think the reason why I'm less optimistic here is just because of all the other charts I'm going to show you in a moment, which paint a less than rosy picture. No change. 5850 is our line in the sand. I think as long as we hold that gives 200 points of room for the for the S&P to pull back and still be in decent shape. We break that level, and I would start to be a little more concerned than I am now. I did a video earlier today for Stock Charts TV. I didn't check to see if it was posted yet, but I do a show every Monday for Stock Charts TV now. And one of the charts we talked about was a version of this chart I'm showing you here. So I'd encourage you to check it out there. We talked about this chart, some others to earnings names to watch this week. But with the S&P, I wanted to show that along with two bullish percent indexes. This is the bullish percent for the S&P 500. This is the bullish percent index for the Nasdaq 100. The bullish percent indexes are breadth indicators based on point and figure charts. So basically, out of the 500 charts representing the S&P 500 members, how many of them have most recently given a bullish point and figure signal? And so as of today's close, it's around 61%. Doesn't seem that bad, right? That seems it's over half. That's pretty good. Here's the problem. At the end of September, it was around 80%. So in the fourth quarter, about 20%, about 100 of those 500 stocks have registered a sell signal on their point and figure chart. And while that might not seem like a big idea, if you know point and figure charts, to get a sell signal, you really have to come down. It's not just you start to turn and then a point and figure sell signal occurs. It really has to come down. It's called a reversal count, where it has to go down enough against the previous trend to register a sell signal. So the fact that 20%, have registered sell signals, actually pretty meaningful, I would argue. Now, compare that to the Nasdaq 100, which is still around 70%. And actually in the month of December, it's been totally flat. So it's about consistent, right? It's about the same number over the last couple months in terms of how many of the Nasdaq 100 names, the large cap growth names, are still bullish, right? Most of them, 7 out of 10, while the S&P has deteriorated quite a bit. So just in the last couple of weeks, about 10, 12% of the S&P members have given a sell signal. Basically, none of the Nasdaq 100 members have done so. So this shows you how the deterioration is happening. It's just outside of the biggest names that have the biggest weights. And again, the market can remain high as measured by the S&P, but I'm concerned as to what that means about the stability of this market. When a lot of stocks are breaking down, we're just not seeing that reflected on the chart of the S&P. Warning signs I would look for would be a spike in volatility. Most of my conversations with guests on my podcast, when I ask them, what are you looking for that would tell you to start to get worried? A lot of them have mentioned something related to volatility. The VIX for me, pushing above levels, right? Moving higher, moving above 15, moving above 16. I actually bumped this up to 16 when I talked with Russell Rhodes, the author of the VIX Traders Manual. He and I talked about 16 as being an important level to watch, but I usually look at 15 as sort of that, general level. As long as we're below 15, things just are pretty low volatility, pretty good. We spike above 15. While that doesn't guarantee that the end of the world is near, it does tell me that we are now entering a higher volatility environment. Pretty much every corrective move I've ever seen has had the VIX move above 15. And so that's why I'm watching that. We're very close to that, but not quite getting there. Now, as I mentioned, all eyes on interest rates. The chart I would be following among many would be this chart of the 10-year Treasury yield. As a reminder, the Fed is messing with the short end of the curve, sort of the overnight rates, the short-term lending rates. That involves a lot of banks borrowing from each other and borrowing from the government. The 10-year yield is further out in the yield curve. This is more of a point on the yield curve that is driven by free market forces, driven by bond investors and their optimism or pessimism about economic growth. It impacts so many things in terms of your ability to borrow and start a small business or buy a car, buy a house, or whatever you need money for over a longer period of time. So the 10-year yield has actually bounced higher over the last week or so as bonds have sold off a bit. But what's really interesting is this bottom portion. This is looking at the shape of the yield curve as measured by a couple different comparisons. Here we're looking at the 3-month point versus the 10-year point. In the bottom series, we're looking at the 2-year yield versus the 10-year yield. And so by measuring just the comparison of those 2 points, we can get an idea of the steepness or flatness or inverted nature of the yield curve. As you can see, we are now back above zero on both of those, which means both of those comparisons, we're seeing long yields above short-term yields. And that is a normal shaped yield curve. Now, why is that important? All right, I'll try not to spend too much time. This would be a whole webcast on its own, just on this one chart. But this is an interesting chart in terms of a little bit of market history. Here is the S&P. We'll start from the bottom. This is the S&P 500 going back on a weekly basis to the mid-1980s. And I did that so we could bring a bunch of rate cut cycles into the picture, right? The Fed does not cut rates very often, once every 10 years or so on average, right? So this is pretty unusual. They're kind of happening. It's happening right now, just because it's not particularly common. So I needed to bring in a lot more history just to be able to see a couple cycles of where this has happened before. So there's the S&P 500 on a log scale. The middle panel here, just above there, is looking at the spread between the 10-year and the 2-year points. We could easily use the other one, the 3-month to 10-year, but I'm using this because I've spent a lot more time analyzing and thinking about this particular ratio. And then at the bottom, we have the Fed funds target rate. So this is actually the target rate that the Fed is, in the process of lowering and has been raising and messing with before. So here's that sort of zero interest rate policy. The ZIRP or ZIRP was there in the post-financial crisis as they kept yields so low for so long. Arguably that really helped juice a liquidity-driven bull market for many, many years in the 2010s. So what is the point of this chart? Besides just showing you what's happened over time, here's what normally happens, right? The economy grows, and eventually the economy starts to show signs of concern, or people start to be concerned a little bit. When inflation starts to grow so aggressively, the Fed has to start raising rates to kind of slow things down, right? And that's where you can see the Fed in these rate hike cycles, right? And that was happening after sort of going into 2018, 2019. Then we had the last rate cut cycle, which was here around 2019 to 2020. That was the COVID era, bringing rates down and then keeping rates low to help encourage economic growth. As the economy is growing, as conditions are getting better, we can see that the Fed starts raising rates, and that's what happened into 2023. But if you look back, you can see that the Fed tends to start lowering rates soon after the yield curve has become inverted, which is that zero line that you see right there in purple. When the yield curve becomes inverted, we soon come out of that inversion and have more of a normal shaped yield curve. You can see that tends to line up pretty well with that first rate cut when the Fed target rate is starting to turn lower. Then we get to these shaded areas. Can anyone guess what those are? Those are recessionary periods. So if you note, after the yield curve becomes inverted and actually becomes more normal, after the Fed actually starts lowering rates, the recession usually comes after that. Now, what you have to remember about recessions is the people that decide when recessions are don't do that until way later, because they have to wait for economic data, which happens way after the fact. Months and months after the recession is when they can actually say, okay, that thing that happened a while ago, that was actually a recession. So instead of waiting for them to label a recession months after the fact, we could cut that corner a little bit and just say, all right, have rates been going up and then stable and now started to come down? Was the yield curve inverted and then started to pop up a little bit? And if you'll notice in the bottom panel, which is the S&P 500, stocks don't do particularly well after you've had an inverted yield curve, which becomes more normal after we have the first rate cuts. And we are most likely in some sort of recessionary kind of period. That chart right there, as a market historian looking at interest rate cycles, is why I'm a little bit concerned right about now, is because markets usually look pretty good when the yield curve is inverted. And once the yield curve becomes more normal, bad things tend to happen after that. Now, it's usually not the end of the world, right? The market has recovered from every one of those sort of choppy periods. But the yield curve inversion, the Fed rate cut cycle, this is what has actually happened over time. So there's your long-term perspective about why this meeting this week and why the Fed rate cuts going forward maybe just help us think about where this lines up with this historical framework that has been pretty consistent. So normalized yield curve, while it seems like a good thing for me, a little bit of a concern here. All right, that was a long-winded analysis of that. Sorry for that. Let's finish off quickly looking at a couple charts. I'll take a couple questions. We'll be done for the day. Alphabet is going higher. We're testing $200 a share, which is a pretty impressive run. I like the chart overall for sure. And a chart like this, I'm very happy waiting for a breakout above resistance, which we've now gotten. I would say measures of volume trend, as we highlighted in a show last week. This on Thursday when we shared this chart before, I think are pretty encouraging. This is the on-balance volume, just looking at the trend in volume over time. Here's the Chaikin money flow, which is a more, I guess, sophisticated way of analyzing accumulation and distribution by looking at the volume on different days based on where we close within a range. You can see from basically from Thanksgiving that the accumulation forces have been very real. The volume has been strong on up closing days. And as a result, this breakout appears to be in pretty good shape. So again, I think the strength in this market is really the strength of Alphabet and a bunch of other charts that are kind of similar in similar sectors doing similar things. Now, it's not all good. Here's the chart of Nvidia, and I mentioned that alert was triggered today. We ended up closing exactly at my line in the sand, so I can't say that it was completely violated. I have an intraday alert set, so first thing this morning, soon after the open, it was triggered. By the close, we're right at 132, which is the low from late October and the low from basically Thanksgiving. So overall, this support level is very much in play. If we get a valid and completed, confirmed breakdown below that support level, I think Nvidia all of a sudden is a pretty disturbing chart, or at least in the short term, showing weakness. You definitely could call that a head and shoulders top, a head and shoulders light top. It's not perfect because double heads are really not part of that. That particular thing, you probably call it a double top more than anything, I guess. But this level of support, whether you call it a neckline or just a support level, I think is pretty clear. Breaking below that, I think that puts downside to around 115, which would be the 200-day moving average. The Chaikin money flow has been kind of rough, right? It's been more negative than positive, and certainly not strong enough to indicate any accumulation, and the momentum has really dried up. We're breaking down potentially with the RSI right at 40. So I think this is a key chart to watch this week. In terms of other things breaking down, Ford Motor Company breaking down a right to $10 a share at the close. It is down about 4%. I just want to highlight this chart because it was one of the worst performers in the S&P. It's a decent yield, right? So it pays a 6% yield. Now, the reason why that yield is so high is because the prices come down so much. So the yield is, the dividends are a lot more impressive as a percentage of the price of the stock, right? So when you buy a stock for $10 a share, you're getting a 6% yield now, which is not bad. The reason why I think this is an interesting chart is because we are approaching key support. Here's the lows from November of 24, right around 970. Here's the low from August of this year, right around 950. We're kind of right down to those levels. I don't tend to buy weaker charts going down, but if I was a contrarian, if I was a bottom fisher, this is the kind of chart I'd probably be kind of keen on, watching things like RSI to become oversold, watching an indicator like MACD or PPO to register a buy signal. That's when I would be much more confident buying a name like that. AT&T was the chart I was thinking of earlier, and I was like, what was that chart that's been in an uptrend and just pulled back today? AT&T was the one I had in mind. Down a bit today, down 3 1/3%, one of the worst performers in the S&P. And again, this is one of those stocks where the chart overall is still okay. The price momentum divergence has been an issue really since October. We're still above upward sloping moving averages. All of that is good. So this is where I go into trend following mode. What would I need to see on the chart of AT&T to tell me to revisit that thesis? And a chart like this, I use things like the 50-day moving average, which we're very close to today. The chandelier exit system, I'm a huge fan of because it's based on average true range. If you own a stock like AT&T and you've been riding this joyous trend upwards, now's the time when I would make sure you have a good exit strategy. What are you going to see on this chart to start taking some of those profits and not give it all back if we get a big deterioration on that chart? All right. Let's take a question or two, and I appreciate some of the comments that I'm getting to. Tony, thanks so much for watching here. You said the Dow down about 8 days in a row, 100%, right? And I think if you look at the Nasdaq and the S&P versus the Dow, when people ask me, does the Dow make sense? Like, why do you have the Dow, on stock charts? Why is the Dow one of the main indexes? Because it's not a great index. And you're right? I mean, if you think about the idea of looking at 30 companies, kind of this random group of large cap stocks, is that a great measure of economic strength in the US? I mean, no, right? There are better ways we could do that. I think the S&P is a much better benchmark. I think the equal weighted S&P is a much better representative of a broader, scope of the economy and how those companies are doing. However, if you think about the benefits of looking at these three indexes and thinking about what their signals mean relative to one another, on a day like today, the Nasdaq up 1.25%, the S&P up slightly at 0.4%, the Dow down 0.25%. To your point, down 8 days or so. And I don't know if that's true. I haven't looked at that exactly, but I'm assuming what you say is probably pretty close to what happened. That tells you a lot about leadership, right? And it tells you a lot about the thematic plays that you can pay attention to. When the Dow is lagging to this degree, this tells you probably don't want to be looking at sectors like industrials, energy, materials, financials kind of sectors, because those are the ones that have a bigger weight in the Dow than they do in the S&P and the Nasdaq. The S&P and the Nasdaq are growth-oriented indexes. When growth is working, they're going to outperform. Look for days when the Dow starts to outperform. That will tell you something's different, and that will tell you we are changing character in some way from the environment we've been experiencing about this quite some time. Tony, I'll take one more question from you, and thanks again. It was great to meet you in Seattle, by the way, at Tuba Christmas. Dave Inc. So it's so funny, and I'll tell you a quick story. One of my early mentors was a guy, Sean Waters. He was the technical analysis specialist at Bloomberg when I started on the analytics desk. And I learned a ton from Sean. And probably some of my conversations with Sean, we used to travel around the U.S. early days in the industry, and I learned a lot from him just about how to talk about the markets, how to ask questions, how to be a good listener, how to present content. And he was big into charts, and I was too. And it was a really fun experience. He would always use Waters Corp, WAT, because his last name was Waters. And I always thought that was hilarious. And I didn't have a Dave Corp or Dave Inc. And now I do. And it happens to be a really good chart, which is pretty funny. True story. I mean, from a technical perspective, I mean, gapping higher and trending is a gap and run, pushing about $100 a share. So I'm bullish on myself, hopefully, but also bullish on Dave Inc. And thanks so much for asking about that. One more question here. Akira asking on YouTube, when you look at a chart, how do you decide the time length you want to look at? 3 month, 6 month, year to date, 1 year, etc. That is I get a version of this question all the time. And I thank you so much watching and asking about this question, Akira Suzuki-san. What time? So I would say the question I would turn back to you is, what is the time frame that you are looking for? What is your investment horizon? When you look at your portfolio, how long do you tend to hold a position? Is it a couple minutes? Is it a couple days? Is it a couple years? And if you can answer that question, then I will tell you how much of a chart you need to look at. In general, I'm looking about 1 to 3 months out on a chart. So when I bring up a stock like Home Depot, my default look back is a 2-year daily chart. I have experimented with a bunch of different things, and through trial and error over many years, have kind of arrived at this as being a really good place. For me, that helps me understand enough of the history to get a sense of the trends. I can think about the short-term movements over the last couple of weeks and think about what that means relative to the last couple months and the last couple of years. And when I'm looking at a couple months, which is sort of this window, this is about the right look back period. If you're not sure what time frame to look at, I would say, generally speaking, if you know your investment horizon, take about 6 or 7 times that back, and that's about the right amount. So looking at 3 months times 6 is about 18 months, which would be about a 1.5-year chart. And so I sort of started around 1 year and then kept building it up, and eventually kept finding I wanted to bring in more data. So 2-year daily chart for me is kind of a good mix. I used to use 1 year because the resolution on monitors wasn't as good when I was learning this stuff. And so on 2 years, you couldn't see enough of the data. Now with a nice high resolution monitor, you can see plenty, I think. So a 2-year daily chart is right for me. So if you're not sure, I would say, look forward. What's your investment horizon? Take about 6 or 7 times that amount. And that should be about the look back period I would start with. And then adjust that, right? If it's not enough, bring in more. If it's too much, bring in a little bit less. And I would start from there. So for me, 2 years of a daily time frame has been pretty good. I think that's it. Hey, thank you guys so much. I appreciate you so much tuning in. Those of you who are watching live and those of you that are not watching the replay, I appreciate you as well. As a reminder, all the questions we did not get to, I will put that in the Chart This mailbag. We've had a lot of fun doing the all mailbag episodes. I am planning one on Friday of this week. So make sure you get questions in. And if you don't have a chance to ask it on the show, just put a comment below the video on our YouTube channel. And I'd love to hear from you. And I hope to answer one of your questions on a future show. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night.